So we have a relatively full house. So thank you everyone for attending this morning, which is the second manager showcase. We're running 4 showcases this week, CoInvestor, and tomorrow and Thursday is EIS and SEIS. But today I'm delighted to be joined by a prestigious group of fund managers to talk about IHT services. Now, this varied selection, many of them with some specialist sector experience, and everyone will be presenting for 8 minutes on their necessary funds and what sets them all apart. Just on a bit of housekeeping, this is scheduled to last 60 minutes. There is a Q&A function. All of you, or the majority of you will know this now within Zoom, so please do submit your questions. And if we apologise in advance if we can't get to everybody's questions, but we will follow up directly individually as well if we can't cover them all off. Now, CoInvestor is a tax-efficient platform specialising in all areas of the market, from SEIS all the way through to venture and beyond into non-tax-efficient venture funds as well. It's free to use for both advisors and investors. So if you haven't registered, we encourage you to do so. And all of the fund managers and their investment products that you'll hear today are available on our regulated platform. But that's it. That's the only pitch from me today. So I'm delighted to be with Tom Hind from Stellar Asset Management, Dan Perkins from Great Point, Derek McClay from Fundamental, Andrew Aldridge from Deepbridge, and Rupert Strakvitz from Velocity Capital. What we'll do is we'll kick off this morning's session with Tom, who's going to talk about Stellar Asset Management. So over to you, Tom.
Fantastic. Thanks very much, Chris. Appreciate the introduction. Good morning, everyone. My name is Tom Hind. I'm a Senior Business Development Manager at Stellar Asset Management. I'm also the Senior Account Manager for Co-Investor Relationships. So I'll be the main point of contact for advisors on the call and also for any investors on the call as well moving forward. I work very closely with direct investors, with financial advisors, with private client law firms, accountants, solicitors, a whole range of other financial intermediaries as well, to explore various ways in which they can help clients and for clients to mitigate inheritance tax liabilities through utilising the business relief legislation. Obviously, business relief set up in the 1976 Finance Act, all about enabling clients to maintain control over their capital whilst they're doing their estate plan. So control is a really important factor here. I've only got 8 minutes this morning, as Chris mentioned. I want to stick to that as well. Obviously, being the first one to go, I don't want to overrun. So I want to first introduce Stellar as a business to anyone that's not come across us before. And then I want to focus on the 5 key reasons, which you've got on your screen now, as to why you should be considering us for your clients if you're an advisor, or considering us for your investments if you're a private investor. The Stellar was set up in 2007. We now have over 350 million assets under management and growing very quickly. Our directors have a collective 30 years experience in the tax-efficient investment space, so they've been around the block a few times. Most notably from their time at Close Brothers previously. They're very well known for their track record in the forestry and hotel sectors in particular, and also the pioneering use of private trading companies to mitigate inheritance tax for private investors are some of the main things you'll see in our proposition as well, using those private trading company structures. We're an owner-managed business. Our CEO, Jonathan Gain, is majority shareholder, still very much involved in the business day-to-day. All of our directors are also got shares in the company. Very ambitious bunch of people looking to drive Stellar forward as a company. We're expanding very quickly. We've just opened a new office in Liverpool, recruited heavily into our investment teams and into our business development teams and client services teams again this year. 2020 has really been a big year of growth for Stellar, even given everything that's happening with the pandemic. Exciting time for us at Stellar and exciting time to be working with us as well. There are 5 main reasons why you should be working with Stellar. The first point on there is experience, and that effectively applies to Stellar as a company. Inheritance tax is who we are, it's what we do. We are a specialist in this space. We've been doing it for 13 years since we were set up, and our directors have been doing it for a lot longer than that. We don't do EISs, we don't do VCTs, which you might see in some of the other talks this week. We don't do standalone investment funds. We're also not an energy provider. We are purely focused on offering a range of structures and services to help different types of clients to mitigate inheritance tax liabilities. That's all we do. We're a specialist in this space. We're a multi-award-winning investment manager as well. I think it's always important when you're looking at business relief investments to say that actually under the bonnet, these are good investments in their own right. We're not just doing this for the tax purposes. We've got multiple awards in our forestry investments and our hotel sectors in particular. One of the standout asset classes for any golfers on the call is the Royal Troon Marine Hotel up on the 18th of Royal Troon. It's been one of our biggest assets for the last 5 years since we acquired it in 2015. We sold it in September time, I think it was, for a 3 times investment return, which was significantly ahead of the target 5% per annum we return to our investors in that service. We've had some fantastic opportunities for growth here. I think it's also very important to note that a lot of the providers on the call, I'm sure everyone will agree, we're doing very similar investments in terms of the strategies and assets we're going in. There is still a good significant upside here, and it doesn't mean that we're taking more risk than others. The first point there is around us as a specialist. The second point is around our range of services, and ultimately the unique selling point here is choice. We offer a very wide range of structures and underlying investment sectors to enable investors to have more choice over the assets they go into and enable advisors to work with a much wider range of clients. Ultimately, for the advisor, it's about unlocking more opportunities in inheritance tax planning as an opportunity or an angle for their business, and for investors about providing them with a wider selection. We offer tailored services for private individuals through the AiM service, the Stella AiM service available direct or on platforms like CoInvestor, the ability to generate a natural income through the Stella Income service, or utilising private trading companies through the Stella Growth service. We also have a business owner service for proposition. So for advisors, a fantastic way of getting referrals from accountants and solicitors, massive opportunity. Lots of the advisors I work with now, so that's a really nice way of growing their business. And for investors, it's for clients that have got excess cash in their companies, or are looking to use the proceeds of a sale, or looking to exit a company, and how they can roll over that company proceeds into a more tax efficient environment. For high net worths, we also offer, so for top clients, for advisors, and for high net worth clients, we also offer the Stella Bespoke service. And this is ultimately a really flexible and unique structure, which enables you to have a lot more say and control over how your investments are going to be set up and the types of assets you're going to be deployed into as well. But ultimately, a very wide range of services to give advisors different types of clients they can work with, and for investors, also the type of services they want to go into. The third point then is on sector diversification. We offer a very wide range of sectors, currently investing into 9 trading activities across our asset-backed investments. Again, feeding into that idea of choice. Our investments are always backed by land and property, so we're taking multiple charges of security in our assets. Ultimately, the benefit there is reducing investment risk and boosting investment return through the assets we invest into. We offer such a wide range because of the amount of investment specialists we have in our company. They're all available on our website. That keeps our investment scope very wide, and it means we're not wedded to a particular industry or asset class, which has been very beneficial throughout the coronavirus outbreak. The fourth point then is on low fees and uncapped returns. Transparency is one of our key core principles. We've been working very closely with Jess from CoInvestor on this. She's been doing a transparency project, which is well worth looking at, and we're continuing to work with them on that. The no hidden fees or charges in our services, very competitive across the board in terms of our fee levels, and uncapped performance returns for our investors as well, which has always gets positive feedback. The last of these 5 points then is the partner services. This is an award-winning service which is quite unique as a proposition in the market, and it provides financial advisors and private clients access to professional services and expert advice as and when they need it. It's not in conflict with the financial advisor, it's about providing that financial advisor with support, advice and reassurance on their estate plans they're putting forward to their investors, and for investors, providing them support in areas they want advice where they don't have it at the moment. Very useful in cracking complex cases that you might have been stuck on for a while, or giving clients a lot more options in terms of how they want their investment plans to look, or just giving them sort of reassurance that what they're doing is the right solution for them. Please do check out the partner section of our website though. There is about, I think, 28 services available on there, so well worth a look. In summary then, 5 key points to focus on and to remember from my talk. First, experience as a manager. We're a specialist. Second, a very wide range of sectors, services, giving you choice. The third point, diversification over sectors. The fourth point, transparent fees, uncapped returns. And the last point, expert partners to call on to give you advice and support when you need it. Thanks very much, Chris. I think you're on mute.
Thank you, Tom. Done the first mute fail of the day, so that's good to get that out of the way. But thank you for being on time. Mr. Perkins, Dan, over to you at Great Point.
Great, thanks, Chris. Morning, everybody. Good to see so many people on the call this morning. As Chris says, my name is Dan Perkins. I'm the Managing Director of Great Point Investments, which is the FCA regulated arm of the wider Great Point Group. Over the next 8 minutes, I'm going to look to take you through a little bit of an introduction to who we are as a business, an introduction and an overview of the creative industry sector, which is the sector that we specialise and have focused on over the last 8 years, a little bit about what the underlying proposition is, and then bringing it all together with talking around the track record and where we think this particular proposition fits within your wider investment portfolio. So to start, Great Point, we've been around now for about coming up to 8 years. Over those 8 years, we've grown the business from 4 people up to 29 people. We were based in Covent Garden. We still have an office in Covent Garden, but none of us are there and haven't been for quite some time. But over the last 8 years, we've managed to raise and deploy over £500 million worth of capital into the creative industries, both here in the UK, predominantly in the UK, and over in North America, with the majority of that capital deployed into the funding of high-end quality television or film productions. And that is what this estate planning proposition that we'll talk about shortly is focusing on. As the business has evolved, we've grown into 4 divisions, all with that creative industries theme flowing through it. That is who we are, that is our business, and that, I think, is probably, of all the USPs and items that we'll talk about over the next few minutes, the USP of our business is very much our creative industries focus and specialism. Within the business, we have a studio infrastructure business, so we manage studios both here in the UK and over in North America, predominantly in the New York area. We have a venture capital arm supporting early stage creative industries businesses through the EIS mechanism. We have a film, TV and sales distribution arm, and our biggest part of the business is the content project finance division, which is what we're going to be talking about shortly. Little bit of background to the market and just sort of highlighting some of these slides, which I appreciate on some of them, some of the numbers might be a little small, but I think it's worth getting an idea of the general market that we operate in and that we specialize in. So on the left-hand side, we have a bar chart which charts 15 of the world's largest producers, commissioners of content. And I think one thing that lockdown has showed us, or the last 12 months have showed us, is that the consumption of content as an asset has become far more of a consumer staple than necessarily a discretionary item. And this is a theme that had been growing pre-lockdown, but has been accelerated during the pandemic, in the sense that I'm sure we can all admit to consuming probably a little bit too much television on those long days, evenings, when we haven't had much else to do. And in 2019, this graph is showing that over those 15 broadcasters, over $120 billion was the estimated content spend. And that's excluding the main UK broadcasters. And is a trend that is set to accelerate over the next 4 to 5 years if the latest reports from PwC are to be believed. Now, why is this good news for an inheritance tax strategy, a business relief strategy? Well, our Great Point estate planning proposition, or GPEP, focuses on the funding of those television shows or projects, films, for the likes of Netflix, Amazon, Disney, BBC, ITV, Channel 4, and the like. And with a booming industry, a growing sector, what that means is, from a deal flow perspective, we have an awful lot of projects to choose from to deliver on our target returns for investors. So what is it precisely that we do within the strategy? It's a straightforward lending strategy. That is what we do. A typical TV show would get commissioned by someone of the likes of a BBC, a Sky, an ITV, a Netflix, and they would be paying at some point 12 months, 18 months, 24 months down the line. We would simply, with the capital that we raised through the vehicle, lend money into the production company that's producing that show, providing them with the working capital to get that show completed, and take full security, first charge security over the contract that is coming through from that particular broadcaster that has pre-bought the rights to that show. It's a tried and tested model. It's an industry that's been operating like that since day dot. Our management team, our senior management team, have decades of experience in that space, in this space, and that's why we believe is a very important piece to how our 5-year track record in terms of performance has been so consistent, especially over the last few years where we've got up to scale, is that the industry is tried and tested. We have a senior management team that is very experienced in assessing these deals, and the counterparties that we're working with are of high quality. So over that 5-year period, how much have we lent? We've lent north of £10 million across 50 odd different projects. We've had 0 defaults across that loan portfolio, and that's what's delivered, allowed us to deliver that 3% target return pretty much consistently, with the exception of the first year when there was a little bit of cash drag as we got up and running from a deployment perspective and some early stage setup costs. Key as well, I think, is to understand that this strategy is geographically agnostic, which is what the pie chart on the right hand shows. You know, a good chunk of what we do is based in North America, a good chunk in Europe, and actually a very large chunk is secured under various different state tax credit regimes. So ultimately, you know, when you're looking at our portfolio and the underlying credit risk, you're not only taking corporate credit risk from the likes of a Netflix, an Amazon, a Sky, an ITV, or a BBC, but also state credit risk, so government risk, UK tax credit risk, etc., etc. So you've got a good split there in terms of who that underlying credit risk is. So where do I believe this proposition could fit within a client portfolio or an investor's portfolio? I think Tom mentioned that the IHT space, the business release space, has been dominated by a number of offers that offer very similar underlying asset classes. We are proudly one of the few, if not the only, purely creative industries focused lending vehicle out there in the business relief market, and so therefore we strongly believe that what we do, given our track record, fits very nicely from a diversification perspective within a wider portfolio, and I think that is where certainly advisors and investors have fed back to us as to where they believe what we do fits in the wider picture. And why do we believe that, that we are a good proposition to work with? Well, we strongly believe in the underlying asset class. We are experts in our field, and we believe that our interests are aligned through our fee structure. We have a very competitive fee structure with no upfront fees charged, no hidden costs, and a 1% AMC that's deferred until such time as we deliver you your 3% in first position. So to bring it all together, I think this is an interesting proposition. It's something that we've been doing since day dot as a business, with very, very strong underlying counterparties, 0 default rates, and a market that is set to grow over the next 4 to 5 years as we look to grow our lending strategy out. So hopefully I've stuck to time, and I will pass back to Chris for the next presentation. Thanks very much, everybody.
Thanks, Dan, for an uplifting message in the COVID world.
I'll try my best.
Yeah, thanks for that. So next is fundamental asset management, and that's Derek McClay. So Derek, over to you.
Brilliant. Thanks very much, Chris. Yeah, exactly. So thank you everyone for taking the time to join this. My name's Derek McClay. I'm a business development manager here at Fundamental Asset. So this session was to talk about what makes us different. So we see ourselves, we are a specialist AiM manager. We have one of the best performing and lowest cost products in the market, with an approach that reduces volatility and liquidity risk, and a lead-in service for advisors and clients. So let me just break some of these points up. So there's 4 main points there. I'm just going to cover each one individually over the next 8 minutes. So we're a specialist AiM manager. So we've always had our own in-house investment management team. And the business was created by Chris Boxall and Stephen Drabwell. Chris and Stephen worked together as part of a successful US equity small and mid-cap fund. They broke off themselves 16 years ago to focus purely on AiM. So Chris and Stephen are the founders, they're the co-managers of all the portfolios up until now for the last 16 years and will continue to be so. So we have a 16-year track record we're very proud of. We're dedicated to AiM, so we only look at AiM. We do analyse unquoted stocks, we look at main market stocks, and we report our analysis through our Investors Champion small cap magazine, equity investing magazine. But we focus on AiM, we build portfolios in the AiM market. And why do we like AiM so much? Well, it's one of the most successful growth equity markets in the world. One of the reasons we expect people to invest in AiM obviously the tax benefits are terrific, but it's AiM as a growth market, which should be the real driving force behind investing in an AiM product is our view on things. So as well as being one of the most successful growth markets in the world, the tax benefits are terrific. So obviously you have your inheritance tax mitigation for an AiM asset held for 2 years and until death. So you don't pay inheritance tax on it. It can also sit within an ISA. So an AiM investment can sit within your ISA. You pay no capital gains tax and income tax on growth. And you also have the benefit with the ISA of the additional permitted subscription allowance. So a surviving spouse can inherit an ISA in its entirety tax-free. An AiM ISA can also sit on a platform, of course, like CoInvestor, and you can transfer an existing ISA in main market stocks. That can be transferred in its entirety over to an AiM ISA product. So this is why we like it. The access issue is also terrific, of course, that your client doesn't lose access to a portfolio in the way he might in a trust structure. An AiM portfolio structure, your client, if they need the money, they can draw on that. It's still owned by themselves. They still have access to that money. So we have an approach which reduces volatility and liquidity risk I mentioned. So we go for the larger businesses in AiM. AiM is not a market just for startups anymore. It might have been towards the beginning, but it's evolved over time. There's some solid, strong businesses on AiM now. Some that have been trading for over 100 years. So one such as James Halstead, which we hold in the portfolio. AiM has others such as ASOS, which has over 4 billion. And there's a market cap of over 4 billion. So there's other businesses that are at that same level. So many well-established founder-led, family-controlled businesses, strong fundamentals, reliable dividends, consistent growth. So I think I've made that clear. It's not just a startup company. You can apply a strategy with AiM where you're looking at much larger, more established businesses. And that's what we do at Fundamental. So there's a few things we like to see from a business. We want to see good revenue, earnings, and organic cash generation. We want to focus on growth. It's a growth market, and we want to see that from the businesses. We want to see real profit, cash generation. We want to see minimal debt. We're happy for businesses to pay a dividend yield, but we'd rather see that reinvested to go towards the growth goal of the business. And we like significant family ownership if we can, and founder ownership, and sensible remuneration structures. Because effectively we want to see things being put back into the businesses. Those are the types of businesses we want to look at. So this strips out much of the noise in AiM, and it leaves us with reliable and solid businesses. And as a result, our portfolio, the average market cap for us is 500 million. So it's very much reflecting our whole approach for going for the biggest businesses in AiM, bigger businesses in AiM. So I also mentioned that, I should say, of course, that going for the established businesses, the whole point is that it helps us reduce volatility. They're steadier ships, if you like. They're stronger businesses. It reduces volatility. We also have a more reliable market for the shares should you want to sell them, or your investor wants to sell them and redeem their money. We've never had a liquidity issue in our 16 years managing our portfolios. Clients are able to get their money back as long as it takes us to process the actual trade. So I said we're one of the best performing in the market. So we've outperformed leading indexes such as FTSE 100, S&P 500, FTSE All Share. We've significantly outperformed those. We're also a top quartile performer against our competitors. So we're top quartile over 3, 5, and 10 years. And to put this into context, over the last 5 years, we've returned 51%. And over the last 10 years, we've returned 280%. And those are numbers to the end of October. That also incorporates our management fee and it incorporates 0.5% advisor fee, for an example. I also said we're one of the lowest cost. So we come in at 1% plus VAT on platform, on CoInvestor. So we don't have any other costs. There's no hidden charges. That's our cost that you pay to use us through the platform and the associated platform costs. We also have a minimum investment of 20,000 on platform. So that reflects an individual's ISA allowance. And I said we had a market leading service for advisors and clients. So if you're an advisor, you can build, we have an advisor center on our website where you can build an illustration, which we can send to you automatically. We also have our advisor guides, which explains how inheritance tax can help you or your clients. We have a series of case studies. So we know that this might not come up all the time, these client scenarios. We know that it could come up only a few times a year. So if you're looking for a refresher, we have numerous case studies that should reflect the scenario you're dealing with. We have our educational CPD webinar library on there. So you can watch our webinars. We've covered topics such as the opportunities in AiM post-COVID, how to discuss risk with clients, which can be a tricky conversation, and also all you need to know about AiM for inheritance tax. There's also details of your relationship manager, and there's direct contact into Chris and Stephen if that's what you want to do. So we don't have an info box. We don't have a front desk phone number for this. If you want to speak to the founders and the portfolio managers, we're happy for you to do that. We're trying to be as open as possible. That's the whole point with the service. And lastly, we have our Investors Champion magazine. So our associated research magazine is Investors Champion. If you're an investor of Fundamental, you'll have access as an advisor or an investor. You have access to the magazine online. So that's really covers the 4 points I mentioned. We're a specialist AiM manager. We focus purely on AiM. We're one of the best performing in our top quartile performance, one of the lowest cost with our 1% plus VAT, an approach which reduces volatility and liquidity risk by looking at the larger businesses in AiM. And we have a leading service for advisors and clients through the Advisor Centre and through Investors Champion magazine. So that takes me to about 8 minutes. So thanks very much.
Okay, thank you, Derek, and thank you for your insights on AiM as well. Always of interest, Derek. So thank you. So next to talk about Deep Bridge Capital is Mr. Aldridge. So without further ado, over to you, Andrew.
Very much, Chris. Good morning, everybody. Thank you for joining us. I am going to take you on a little bit of a journey this morning. You've obviously heard about the background to business relief, what business relief means for inheritance tax planning. So I'm not going to dwell on that. I will refer to business relief as we go through, but I'm not going to go into the background, etc. You should all know that from the previous presentations. But if you do have any queries, then you can pick up the phone and we can go through that. So just a very quick introduction to Deep Bridge Capital. We are celebrating our 10th anniversary this year. Unfortunately, celebrations were slightly put on hold to COVID, but we're going for 11 is the new 10 next year and celebrating properly. We invest in 3 sectors, and we invest as sector experts in those fields. So we don't invest outside of these 3 sectors. So under our EIS propositions, we invest in technology and life sciences. And then for our BR proposition and historic EIS propositions, we invest in renewable energy. So we've been investing in the tax efficient space for about 7 years. We now have well over £160 million of funds under management, about a quarter of which is into the renewable energy space. And our IHT service is purely focused on renewable energy. We don't look at anything else around that. It is purely renewable energy. So if you are looking for renewable energy assets, then that is all you're going to get with Deep Bridge, and that's what we're looking at. That will include wind, it will include hydropower, it will include anaerobic digestion. So why renewable energy? Well, if I take you back 10 years, if we go back to 2010, in the UK, the renewable energy share of electricity generation was around about 6% of the overall energy mix in the UK. Fast forward to the period April to June 2020, and that was north of 44%. So you can see renewable energy, it's not just a gimmick, it's not just a government strapline, etc. This is fundamentally changing the way we produce energy in this country. And if you look at that in terms of installed capacity, back in 2010, that was around about 11 gigawatts of 11 GWs of energy was produced from renewables, and that's now nearly 5 times that in 2020. So again, that capacity installed in the UK is growing all the time, and it's a key market for investors alike. I think again, if you go back 10, certainly 20 years, investors, if they didn't have BP or Shell in their portfolios, there's probably something wrong with their portfolio. Similarly now, I think green energy needs to be in people's portfolios. Is a growing market. It's a key driver for change and for energy production in the world. And we used to, when we did these presentations 3 or 4 years ago, we used to look at the statistics of green energy investments versus fossil fuel investments across the globe. We don't even mention that anymore because green energy investments way outstrip fossil fuel investments, as you'd probably expect these days. So kind of bringing it back to Deepbridge, that's kind of where we've come from. That's why renewable energy is an appealing market. Why isn't it an appealing market from a business relief perspective? Well, ultimately, they are genuine assets. You can go and kick a wind turbine. You can go and see a hydropower site. They are utilising defined technologies that have been tried and tested. I mean, wind turbines, hydropower sites in their rawest form go back centuries. So we utilise tried and tested technologies. They are robust. They're predictable incomes that we're getting, etc. And also, you are effectively selling to 2 grade A counterparties. Either your assets are going to qualify for government subsidies, in which case they are index linked government subsidies, which are all of our sites that have got subsidies, they are reaching out up into the mid-2030s. And equally, you've also then selling into grade A counterparties, which is the electricity companies. So again, you don't really have that major risk of how these companies are going to actually sell what they're producing. It should be taken almost as read as that there is a market there for that. I think it would be remiss not to talk about risks, and the risks when you're looking at renewable energy propositions, obviously, if you are building, then there's planning, there's construction risks, there's consents, etc. So before we put any money into any site, we make sure that all planning and applications, all environmental licenses, all wayleaves, etc., are all already in place. We utilise contractors and specialists who are specialists in this area that were, again, tried and tested. So again, from that aspect, we're trying to mitigate risk at every single step we take. This is about capital preservation. We're not chasing returns that some other providers may well be returning. We're looking to produce somewhere probably between 4 and 6% per annum. And again, those are based on relatively predictable revenues. Our assets are all fully insurable. So again, our wind turbines, for example, if they are not producing electricity for 5 days, then they qualify for loss of income insurance. So again, it's trying to mitigate that risk, take away risk wherever possible, to make sure that people can see what they're investing in, can feel what they're investing in, and can benefit from that. So in our pipeline, in our portfolio at the moment, we've got a mixture of onshore wind, we've got a mixture of hydropower, and we've got a mixture of anaerobic digestion. Like I said, over £40 million of investment to date in renewable energies by the team at Deepbridge. And as we go forward, what does that pipeline look like? Well, all of our sites to date either qualify for renewable obligation certificates or feed-in tariffs. Most of those government subsidies are going away, and quite frankly, with good reason why subsidies are diminishing in the renewable space, is because a lot of sites no longer need subsidies to be economically viable. So again, if you go back a few years, the cost of a wind turbine was prohibitive, particularly a small-scale wind turbine, to actually producing the yields you needed on its own. But as that technology gets cheaper, those turbines no longer need subsidies to be an appealing investment proposition. So as we go forward, we are looking at bigger sites, we're looking at more onshore wind, we're looking at more hydropower, we're looking at anaerobic digestion, we're looking at potential energy parks, which will have a mixture of various elements in them, and we're looking at potentially solar panels, etc. as well. And we're no longer looking just in the UK, which is where all our sites are to date. We will be looking internationally to make sure we're identifying the right opportunities for our investors with the right returns. So I think, from our perspective, what are some of our USPs alongside what I've just mentioned? We think renewable energy is an appealing proposition in this space, and I think it's you can relatively predict the revenues coming in. You can insure against losses. You can make sure that everything is in place prior to putting a spade in the ground or acquiring an already energised asset. We don't have any gearing against any of our assets, so again, we're not chasing returns by putting in gearing. Our proposition has been HMRC tested, So it's successfully been reviewed by HMRC for business relief. And ultimately, from our perspective as well, as it says on the screen there, we don't charge fees to the investor. All of our fees are charged to the underlying trading company. And therefore, if you put £100,000 in, you get £100,000 worth of business relief, so that we can make sure that that's in the best interest of the client. So in a nutshell, that's Deepridge. We are sector experts. We believe renewable energy makes a great port in a portfolio of BR propositions, and we think it works well against a number of the propositions you've seen already today. It works alongside those nicely. So that is us in a nutshell. And any questions, please give us a shout. Thank you.
Okay, thank you very much, Andrew, and always interesting to get an overview of your thoughts and perspectives on the wonderful world that is green energy. Last but not least, for the general presentation, we're joined by Rupert Strachwitz of Velocity Capital, who's looking very snug in his
Thank you, Chris.
his cozy office there. Rupert, I'll hand over to you.
Yes, thank you very much, Chris. Good morning to everybody. My name is Rupert Strachwitz. I'm the MD and co-founder of Velocity Credit. Velocity Credit sits within the Velocity Capital sort of group, which has been focused on tax-efficient investing since 2015 in the SEIS and EIS space, primarily focusing on UK tech-enabled businesses. And we now have within the Velocity Capital companies 18.5 million sterling under management across 32 companies. But Velocity Credit, so please change the word capital for credit in this presentation, is part of the Velocity Capital Group, and we're focused on, as it says in the name, providing credit to UK corporates. So as a business, we are primarily a lending business. We set up Velocity Credit based on some technology that I developed together back with Velocity Capital to support UK SMEs in cross-border transactions, enabling them to access, or more efficiently access, lending capital, financing capital to facilitate cross-border trade. We realized there was an opportunity to provide credit to these companies and set up a credit business. During that process, we realized, in fact, this is suitable for, or as an IHT service, but primarily we are a credit business with a product which is suitable for investors who wish to avail of IHT relief. So with that in mind, what do we do? Well, we provide financing of a defined cash flow to UK corporates. These are typically mid-sized corporates, and the financing is there to, as I said, finance a future cash flow, and that cash flow is utilized to repay the debt. Now that sounds complicated, but I think it's easier to explain what we don't do. We don't provide general working capital to businesses with general security. We provide defined lending against defined cash flow. For example, invoice discounting, for example, trade fulfillment, cross-border transactions. We pre-finance tax credits, and we also finance asset acquisitions where that asset produces a defined cash flow. Now, all of this is short-term. So as you can imagine, an invoice discounting, some lending programs we've got running at the moment are 30 to 60 days. Some of the asset acquisition financing is longer term, but where the median repayment profile is about 12 months. So we view our credit portfolio as a short-term lending program. Typically, the security is as you would expect on any lender to a business, including fixed and floating over the company itself. Often we take personal guarantees from directors and or shareholders. And in many cases, we ring fence the cash flow, which is used to repay the debt within an escrow service so that the borrower itself doesn't get the capital until the loans have been repaid or the invoice has been paid. In terms of looking at all of our lending activities. We're a great promoter of ESG, so we're signatory to the UN Principles of Responsible Investing. And what does that mean in reality? In reality, we only lend to sectors which meet the environmental, social, and governance criteria that we set out. But above and beyond that, what we try to do with our borrowers, bearing in mind some of them are sort of mid to small size companies, we do try and impose upon them or promote within them principles of ESG. And we think we're differential in terms of lending business in doing that. But we're very proud of our ESG credentials. Lastly, we're obviously living in a strange economic environment. Where are we in the credit cycle? Well, we're probably not yet at the bottom. For us, this is not a challenge, it's an opportunity. We launched Velocity Credit in the summer, and we have therefore the advantage of not having a portfolio of deteriorating assets, and we have the advantage of knowing that there are resilient and non-resilient economic sectors. So we're working with some UK fintech businesses who are capable of analyzing, rating, and forecasting various parts of the economy. So we're focusing on, fortunately, it is good to say there are parts of the economy which are still resilient, and there are parts of the consumer market which are actually benefiting from the current crisis. And so we can focus on those sectors and lend to those sectors. Lastly, a little bit about ourselves. We're a team with a very deep credit experience. We are a team which comes from Morgan Grenfell, was at Deutsche Bank, ran a large credit portfolio there. We come from Commerzbank. Our credit policy officer ran a €4 billion credit portfolio at Commerzbank, and my background is financial services, having been at Dresdner Kleinwort. So we're a team which has been in this sector for a long, long time, got a great track record, both in business building as well as credit lending. But it's fair to say we've come together recently to launch a service, but I think our CVs and our expertise speaks for themselves. As a service, we have two offerings for investors. We have a service for individual investors where they can come into a portfolio management service. We're also just about to launch a service for corporates, so that any corporation or business which is in danger of either not trading or holding too much cash and therefore being considered an investment vehicle rather than a trading vehicle, we can offer a solution to them or to that business, those investors in that business, to participate in the loans that we are originating, structuring, and lending on. Why is this service different? To wrap up, primarily, it's the natural liquidity. So if you can imagine a portfolio of loans of different sizes and different terms from 30 to 90 to 120 days, the service itself has, or the trading companies themselves have natural liquidity within them as the capital is deployed and repaid. So for us as a manager of those companies, we recognize that investors will at some stage exit, and that exit is achievable through natural liquidity within the service, rather than having to rely on incoming investors to buy shares for an exiting investor. We also use credit default insurance on what we call primary risks. So where we're lending to a borrower on a single invoice against a single obligor, we take our credit default insurance with an insurtech business called Nimbler, other than where we, and we're doing this a number of occasions, lending to businesses which have governments as counterparties that we don't buy credit default insurance. So just as a wrap up, the lending is cash flow backed, or is asset backed with security, in some cases credit default insurance. As an investor, there are no fees to pay going in. The fees are covered by the trading companies, and net of all those fees and costs, we are aiming to generate a target return of between 3 and 6% per annum. And lastly, I would say we see ourselves very much as part of a solution for IHT for investors. One is capable, and one with a service is structured such that an investor can come with a relatively small amount of capital, dip their toe in, see how it works, and then we can do a rights issue to up their commitment over a period of time without impacting their BR clock, so to speak. So we think it's an interesting solution, different solution for investors, and one we're proud of in terms of being able to support UK businesses during this critical time. Over to you, Chris. Thanks.
Yeah, thank you, Rupert, for a very sensible look at the wonderful world of credit. So thank you. So we've had some interesting questions come in as you guys have been speaking. So maybe to run around the room with one that's come through on sort of risk correlation. You know, obviously it's the centre of everyone's thinking at the moment is risk. So I just wonder, you know, from your own perspective, how do you measure risk? And maybe if I can ask Tom first.
Yeah, no problem at all, Chris. I think hopefully something that stood out in my talk earlier on was around the amount of diversification of sectors we give to our clients and to our investors. I think obviously with the global pandemic that's happened, it's not really been in anyone's control, but what we have been able to control is the type of assets that our clients are going into. Because we offer so many sectors, it's meant that we can actually go into sectors that have been quite robust throughout the coronavirus outbreak and reduce the exposure of our clients into some of those assets which have been greater impacted. So to put that in an example, UK forestry has had another fantastic year in terms of its performance. We've been very keen on putting more clients into forestry holdings. Obviously, the hotel industry has been largely closed this year. They're reducing clients' exposures to the hotel sector. But ultimately, from our perspective, it's just about offering more diversification to more sectors and keeping our investment mandate flexible so we can adapt to the current economic environment.
Okay, thank you, Tom. And Dan, how do you measure risk?
Yeah, so I think risk in our sector ultimately, there are two key elements to our trade. One is the risk of a counterparty defaulting, and that, you know, we analyse that, monitor that through a mixture of looking at some of the bigger entities, looking at credit ratings. Some of the smaller entities won't necessarily have credit ratings, but that's when you look at the track record of that broadcaster in terms of their history of paying on time and to the amount specified. Then the other piece is around delivery of the product. So, and that's probably the biggest risk, is actually if a program has been commissioned to be made for an ITV, is that program going to be delivered on time and to the specification that ITV have pre-ordered? And if it is, and that all comes down to the production team that's working on the ground to make sure they're delivering the asset that was ordered, then, you know, we know that we've mitigated that risk as far as possible. There are also insurances, you know, that you can take out to ensure that, you know, trading day-to-day risks are mitigated. In certain instances, on bigger projects, you can look to take out completion bonds on bigger films to make sure that that project is delivered. And, you know, the day-to-day trading risks, you know, they are covered through a suite of insurances that we would ensure is in place, condition precedent of every single loan agreement that we go into. So, you know, those are the two key risk areas, and how we tend to manage it on a loan-by-loan basis.
Thanks, Dan. Thank you. And Derek, how do you measure risk from fundamentals perspective?
Yeah, well, from our perspective, the biggest risk you have is the risk to loss of capital. So, of course, looking at the market recently, the FTSE 100 seems to have that's where the biggest loss to capital has been this year. For many of the equity markets, AiM has performed much better. So we found that many of the businesses we're investing in AiM have actually managed to mitigate against losing your capital completely, in a way that the FTSE 100 hasn't been able to do recently with COVID in the last year. So that's one thing one observation that we have. Volatility wise, we also try to mitigate against excessive volatility through our approach by looking at the larger businesses in AiM, which I went through during the 8 minutes. And also on top of that, we try to diversify the portfolio as much as we can. So we're in various different areas. AiM has a wide selection of sectors that you can be in. We're in the UK's biggest vet. We have numerous tech businesses. We're in a flooring company in James Halstead. We're in the computer game business. We also have extraction companies and a holiday company as well. So we're very much diversified across very many different spaces and sectors, and that's how we manage risk.
Okay, thank you, Derek. And Andrew, how are things looking from a risk perspective over at Debrief?
Yeah, so from a renewable energy perspective, I think certain kind of risks the other guys have mentioned are probably less pertinent in our sector. So, for example, counterparty risk. We've got two counterparties. One is government with the subsidies, and the second is grade A counterparties in electricity companies. So you've not got that same kind of counterparty risk as elsewhere. Diversification, I think, is a key thing, which is why within renewable energy we split our investments across wind, across hydropower, across AD. Like I said before, we're looking at some solar, we're potentially looking at some offshore wind, etc. So within that market, if the wind isn't blowing for a period of time, then you still got your hydropower, you've got your AD, etc. So again, that diversification, but not taking away the sector expertise of actually building and running these things. So I think the two key risks in our sector is, one, the construction risks. So where we are building a site from scratch, there's obviously the construction risk there, which can be counteracted by just having robust processes, due diligence, working with tried and tested partners. And then there's the ongoing management and running of a turbine, a site, etc. So again, it's working with key management and servicing partners to make sure that we've got a robust policy in place to make sure that everything is reviewed regularly, serviced regularly, optimized, etc. And then the final thing, which again, I think you touch on, is that everyone should remember that these are unquoted early stage companies, in the sense they're not big blue chip companies. I appreciate on AiM you might have some bigger companies, but liquidity is always going to be your key thing when you're looking at these things. And there is the illusion of liquidity with AiM, which is great and can certainly help within a portfolio. Obviously, with renewable energy, they are assets, they are genuine assets. So bank refinancing is available to us to be able to produce liquidity if we need to. But also in the renewable energy space, there is a very active secondary market. For the reason we touched on earlier about the investment going into renewable energy, there are a lot of players in the market. We're acquiring regularly, so a lot of our peers, etc. So there is a lot of activity there. So actually, although these are illiquid investments, we would expect that liquidity should be fairly easy to come by, and should be able to be sorted as and when required.
Okay, thank you, Andrew. And Rupert, what's your view on risk, and how do you manage things?
Well, we are all about measuring and managing risk, clearly, as a credit business. There are three levels, Chris. One is measuring going in. So on a typical credit transaction that we do, you've got two parties. You've got a borrower and you've got his customer or his obligor. And both of those we can measure in terms of probability of default. We use some very smart software developed by a platform called Wiser Funding. It's a proven technology which sources data from the borrower or the obligor's accounting system through to public data, and you can then measure the probability of default. Then during the transaction itself, this is about structuring. So de-risking transactions about structuring it correctly, including use of collection accounts and escrow accounts, and the use of the credit default insurance. And lastly, on a credit portfolio, the other sort of high level risk is concentration risk. And that is just a simple process of managing where the capital has been deploying and making sure you don't have too much sector or geography concentration.
Okay, thank you, Rupert. Actually, that ties us in nicely with one of the other questions that's come in through the forum. And Andrew, you touched upon diversification as well. So one of the audience is asking how many trades or how many investments would an investor gain exposure to within the fund. So Tom, perhaps we can kick off with you. You explain how that would work.
Yeah, no problem at all. It really depends on what service you'd be using with us. Obviously, we offer 6 different services at the moment. So depending on the service you go into, it would really depend on how many trades you're being exposed to. If you look at our AiM portfolio, we're very similar to the fundamental one in terms of the amount of diversification you're getting in there. We hold a maximum 40 stocks in the portfolio. So at the moment, it's 37, so quite highly diversified at the moment, given the volatility in markets. So if you're looking on the AiM side, you're looking at 37 different companies. On the non-AiM side, we've got the income service, which is investing into naturally yielding trades. In there, we've got the hotel sector, we've got construction finance and bridging finance in there as well. The 3 overarching trading sectors. Beneath those, you've got a variety of different actual underlying projects. So again, the good level of diversification below that. In the non-income focused side, on the growth side, that's where you're exposed to all 9 of our trading activities. So 9 actual individual sectors, from forestry, farming, hotels, And underneath those sectors, you've got a variety of different projects in there as well. So, as I mentioned, diversification is something we're very keen on. We offer a very wide range of sectors and underlying projects.
Okay, thank you. I'm expecting quite different answers across the group here. So, Dan, how are you managing diversification, and how many investments would an investor typically get exposed to?
Yeah, so I think based on the size of the fund at the minute, an investor could expect to have exposure to anywhere between 10 to 20 different loans. Obviously, if that, if the fund scaled, dramatically, and you got up into the hundreds of millions, obviously the number of loans that you would be doing would increase, and the size and scale of those loans would increase. We have exposure to, as a business, we have loans ranging from anywhere to a couple of £100,000 all the way up to 20-30 million pounds. So it then becomes a question of scale. But right now, 10 to 20 loans would be where I would suggest.
All right, thanks, Dan. And Derek, same question to you.
Yeah, well, we would probably have around 25 positions. That's how we build portfolio. We tend to, we don't want to overcommit to too many smaller positions. We want to be committed to the 25 that we like. If you gave us a larger investment, we would start to build a larger portfolio. So it depends. We build tailored portfolios with every portfolio. They're bespoke. So, but we do have our choice businesses that we use for those. We're diversified across many different areas. Like I mentioned when I answered the earlier questions, I won't go through it again like that. But we are across lots of different sectors and spaces that you can be in with an AiM. And it's important for us to actually not just be completely committed in one direction, but to actually have that diversification across different areas. And it's helped us through COVID, for example, where we haven't gone into a negative position by any means, in the way that perhaps the main market may have done. We don't have the concentration risk, so we're able to again have our portfolios a little bit more targeted for those businesses that we like the sound of, and we tend to hold for the longer term as well. So we don't chop and change our portfolio very often. We might only do a couple of changes a year, so that's how we tend to approach diversification. We're across lots of different areas with an AiM.
Okay, thank you, Derek. And Andrew, how many investments would an investor typically gain exposure to within DeepBridge?
So I think that there's two elements to the question. One is how many companies or how many holdings. So an investor will be invested into one trading company, but within that trading company, currently we've got 14 renewable energy sites. So that's how you get your diversification. It's on the site level underneath the company. We've got another 11 sites that we're expecting to add into the portfolio over the course of next year. So investors will probably look somewhere between 15 and 30 sites, if they're investing over the course of the next 12 months is probably where we would expect them to be. I think the key thing from our perspective when we talk about diversification is that, yes, you do have diversification across different sectors within renewable energy. One of the things that clients, investors, advisors should be looking at as well is also kind of that manager concentration as well. So we always talk quite openly on the fact that, if you are investing in the DeepBridge IHT service, you'd probably do that as part of a portfolio. So you probably wouldn't just stick all your eggs in one basket. So you might have, you might have a bit of renewable energy through DeepBridge. You might go to Rupert to do some lending. You might go to Dan to do something in the creative space. You might look at, speak to Derek regarding AiM, etc. You might look at Tom to go to kind of like more generalist and kind of more diverse there. But what you'd probably do is pick those. You might have one bit of lending, one bit of renewables, one bit of leasing, one bit of creatives, etc., one bit of AiM. And you split it that way. So you've got the sector diversification as well as the managed diversification. I think there's a bit of a misnomer sometimes where certainly some bigger fund managers will come along and say, give it to us and we'll do the diversifying for you. And I think that's a bit of a misnomer because you've still got all your eggs in one basket with one manager. Yeah. What I would say to anybody looking at this space is actually split your investment across a few managers and get your sector diversification and your manager diversification at the same time.
Thanks, Andrew. You know what would be really helpful, Andrew, would be a platform that would enable you to do that quite
I will set up the sales pitch for you, Chris, and you just knock it out of the park. Yeah.
Thank you. So perhaps Rupert, we're kind of running out of time. So perhaps you could wrap up the event for us then, please, on on sort of diversification and investments from your perspective?
Well, that's an easy one to answer, Chris. So thank you. For 2021, we had 25 borrowers, and each borrower would have 3 to 10 underlying obligors. So there's your diversification, maybe between 100 and 250 underlying credit exposures.
Okay, all right. Thank you, Rupert. That was a very simple answer to an interesting question from the forum. So we're out of time. So I'd just like to thank everyone for attending. If you have any further questions, please direct them to the team at CoInvestor or directly to fund managers. As Andrew so beautifully teed me up, that all of these funds are available on the platform, and if you wish to build a diversified portfolio, then please speak to me or any of the team at CoInvestor, and we can get you started on that journey. I'd like to thank everyone. I'd like to thank Andrew, Rupert, Derek, Dan and Tom for your time this morning, and to thank all of the audience for attending, and look forward to following up with all of you. So thank you. Thanks, guys.
Thanks, Chris. Good day, everyone.
Thank you.
Thanks very much.